Good morning, it's 9:02. I would like to call this meeting to order. Thank you for joining us during our weekly hybrid MLS breakfast meetings. My name is Tom Zeng, and I'm your February program chair. A bit about myself. I'm a broker associate at Universal Elite Realty. I've been practicing real estate full-time for 14 years. My experience in real estate includes standard sale, short sale, REO, flipping, multifamily residential, and I'm slowly shifting my focus towards warehouse buying, leasing, medical office, and some commercial retail spaces. I've been serving as director of WSGVR since 2022. Some of my designations include Graduate Realtor Institute, CIPS, and At Home with Diversity. I have chaired Global Business Council, YPN, vice chair in the Legislative Committee in the past, and I'm honored to be your February program chair this month. Now, help me welcome our guest speakers, Regional Vice Presidents with Exchange Resources, Marcus Jacques and Adrineh Betcheri.
Good morning, family. It's always good to see you. Now you're seeing me under a different light. Adrineh and I are the new face of Phil Atwan, our beloved and esteemed colleague. He retired in December, but not before equipping us to do his job. And we have been having such a great time. We're called the Navy SEALs of our company because she has an escrow background and I have a title background, and it's working well with the 1031 exchange. So today we're going to give you a brief intro about the 1031 exchange process. I start off always saying that we bring great news. We bring really good news. At least that's what we're told wherever we speak, because I think by talking about the exchanges, we get realtors off of the mind of the new commission structure, because with exchanges, commissions are a non-issue, and you'll see why. So let's start with our slides. First, we have to give a disclaimer. We are not tax professionals, and neither are you. Maybe some of you are, but when it comes to real estate, you probably don't conflict in interest. So you're going to be seeing some tax calculations. You're going to be getting some tax information. It's for educational purposes. Next, who are we? Well, Phil was one of the founding members of our company, and we've been in business now 26 years. We've done over 60,000 exchanges. What sets us apart from other qualified intermediaries is that we do not commingle funds. We have what is known as segregated accounts set up for each exchanger. The other thing too is that we're independent. We are not affiliated with another real estate service like an escrow or a title. We're completely independent. And lastly, I will say this. While we're not regulated by any entity, we are rigorously audited. And one small discrepancy could disqualify not only our past 26 years, but anything in the future. Next slide. So let's take a look at what capital gains looks like. This is how capital gains is calculated. You take the sales price and then you subtract the adjusted basis, which is your purchase price, plus capital improvements minus depreciation. Now, I point this out. How many of you as realtors have been asked before, I need to figure out my capital gains, right? That's a question that you should not answer. This is a question that their CPA should only answer. But I've come up with a little realtor wink about how to make yourself feel good when you have to tell them that you can't give them that information. Anytime a person asks you, I need to figure out my capital gains, I can't do that calculation for you, but what I can do is provide you with the CMA, and that will give you a current market value of your property. So you can take that information and get exact numbers from your CPA. Next. Okay, let's take a look at what the capital gains levels are like currently. First, we start off with, first we start off with 20% from the IRS. Next is California state tax. This is if an investment owner were to sell their property, what they would be looking for, what they would be looking at in terms of capital gains. We start with 20%. This is a mistake. It's only up to 13.3 for the California state. Medicare surtax is 3.8. And then we have this depreciation recapture, which I've separated here because, as you know, when you're an investment owner, your CPA will draw out a depreciation expense that you can take every year that you can claim on your taxes. Well, whether the investor does that, uses that depreciation or not, when they sell their property, the government wants 25% of it back, whether they've taken it or not. So what happens here is on that $1 million gain that you would have, it would be consumed by approximately 40% or more, depending on your tax bracket, leaving you with only 60% of the proceeds to use for reinvestment. Okay, let's take a sigh of relief. If somebody needs to take a Tylenol, that's good. A drink, right? You need to take a drink. This is how high it is. California, ding, 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 we're the highest tax state. We're the winners because we're kind of broke. But anyhow, this is what's the solution to this situation, folks? Next slide. The 1031 exchange. Next slide. So here's a little history lesson for you. Back in 1921, we were kind of like in the same situation. We were coming off of the vestiges of the 1918 pandemic, and we ran into a farming crisis. I don't know how many of you are familiar with agrarianism, but there's such a thing as crop swapping, where a cultivator will cultivate a certain crop for a number of years, and they'll leave it fertile for another crop to come in. And when they do that, they usually exchange their farms for another place where another crop has been leaving the soil fertile. When they were doing this, they were realizing an incredible capital gain. So they got together with their Congress folks, and they enacted the code, the 1031 code, for investment owners to defer their capital gains by exchanging one investment property for another. Okay, so here's some requirements. The intent: the property must be held for trade or for business or for creating income. All right, they have to report that on their taxes in Schedule E for 2 years. It has to be held for a minimum of 2 years. Then the benefits the benefits is that you can defer, not cancel. You can defer your capital gains when you sell that one property at that value or higher. You replace it with another investment property. All right. So you can defer the payment of capital gains. You can reinvest 100% of that stuff as long as you don't touch any of the money. It goes to the other property, and it gives you increased buying power because properties appreciate. You could sell that one and maybe buy 2, 3, or more, right? So next slide, please. So I'm going to hand it over to Adrineh. She's going to talk more about the requirements.
Good morning, everyone. Really glad to be here today. Thank you for having us. So the like-kind property question came up when I was doing escrow. The like-kind property question came up a lot when I was an escrow officer. One of the questions the agents always asked me was, if they have a condo that's been rented out, do they have to swap it for another condo? And the question is no. The different type of properties qualify in a 1031 exchange. The exchange must have the same use. It's not the type of property structure that qualifies it. So single family rental homes, multifamily, condos, vacant land used, for business. I just had one, it was an orchard, and they qualified for a 1031 exchange. Ranch land, commercial, 30-year plus leaseholds, oil, gas, and water rights. Also, very commonly being used right now are DSTs, the Delaware Statutory Trust. With the DSTs, what the investor does, those investors that don't really want to get into any type of structure that has, let's say, rentals.
They just want you to be in camera. So go ahead.
Okay.
You're good right there.
Okay, so so any type of an investment where the investor does not want to exchange into a property again. They're looking to buy maybe a slice of the pie, as they say, instead of the whole pie. The DST is an option for them as long as they have at least a net worth of $1 million and they can invest at least $100,000. We have DST brokers and sponsors that we work with. And with the DST, they're not really in control, but they do get that income every month, and it's a good option to look into.
Next slide.
Properties that do not qualify, primary residences where people actually live, do not. So what doesn't qualify is any type of personal property. For example, if we have a real estate office like this and the investor owns the land and the structure, they can do an exchange with the actual rear property part, but not the computers, not the desks, anything that's not attached as personal property, they have to exclude from the exchange. Also, REITs, stocks, any type of developments that are, going in phases, or people who are flipping properties, those do not qualify for 1031 exchange.
Next slide. What about vacation homes though? Your second home would not qualify, but your vacation may, if under the following criteria, the property has been owned and held for at least 2 years, and then the property was rented at fair market value for at least 14 days of each of the previous 2 years. So 14 days per year, right? And then personal use of the property, including when you invite your family over for a skiing trip, like we saw with Alina. Okay, so here we're going to take a look at the sales price. What happens? And this is where you want to pay attention, realtors, because this is the part that you play a very important part in. So the sales price we said was 1.5 million. Did you know that that the investor can deduct from that replacement price any non-recurring closing costs? That includes commissions, wink, 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 escrow fees, title insurance fees, the transfer taxes, yes, including those mansion taxes. They can deduct them from their taxes, recording fees, our measly fee, and any contractual agreement between buyer and seller for repair. So there's many times that they have to offer a credit. Well, that credit, as long as it's part of the transaction, it's going to be considered a one-time non-recurring closing cost. What that does is it adjusts the replacement price. They would have to sell at 1.5 million. The replacement property has to be worth 1.5 million or more. But after you adjust these costs, you bring it down to the minimum value of replacement, 1.4 million or higher. All right, next slide. Next to you. This is
Rules that we go over with every client anytime that they hope. One of the requirements is the tax ID number that sells must be the tax ID number that purchases the replacement property. Now, if you have a trust, let's say we have an investor, husband and wife, they have a trust and they're filing their income taxes under their social security numbers, then they could buy as individuals or in a trust, because that is the same way they're going to file their income taxes when they purchase. If it's a single member LLC, most commonly single member LLCs file their personal taxes under their own individual social security. So they can buy either in the LLC or by themselves. However, the question comes in when it's a multi-member LLC. And a multi-member LLC has its own tax ID number as an entity. So if they sell it, they must buy under the multi-member LLC. Now, if you have clients who have questions about partners going separate ways and the way they're filing their taxes, you can contact Marcus and we can go over detail as far as what is called a drop and swap and drop. But we want to leave the tax ID numbers the same, because that's how the IRS ties the transaction together from the sale to the purchase. Tax ID number.
This is the timeline. This is the very strict timeline. In a 1031 exchange, you have 180 days from closing to closing. 180 days, calendar days. Weekends and holidays count. 180 days. Now, the first 45 days of that timeline, the first 45 days are the identification period where the exchanger must identify 1 to 3 properties. We'll have a slide on that, but they have to identify 1 to 3 properties that they plan to close on. Okay. They can change that 45-day, they can change that identification list 100,000 times up until midnight of the 45th day. Okay. Up until midnight of the 45th day. After that 45 days is up, then they have to close at value on 1 or 3 of the properties in order for it to be an exchange. Sometimes we've seen where they've identified a property on the 38th day. They get into escrow on the 39th day. 45 days go by and they fall out of escrow. What happens then? We all got to get on our dimple knees and pray that one of the other 2 properties that they've identified are available so that we can close on those. If we do not close on any of those, or if those are no longer available, it's a failed exchange. And the worst part of the news, the worst part of this news is those monies that have come in to us, they cannot be held in escrow. We've set up an exchange so that the monies from the sale come to us. You do not touch that money. But that money that has come into us cannot be returned to the exchanger until the 180th day by law. Okay. So this time period starts when you close on the first property and those monies have come into us in a segregated account. That starts. The next day is day 1 of 180 days. Yes. Well, we do allow for some interest over of sales over 2 million, money over 2 million, and they will be able to receive that interest, but the money cannot be returned in its entirety until after. Okay. Anything that you wanted to add to that?
The only thing I do want to add, if for any reason the investor decides they do not want to go through with the exchange and it's before the 45th day and they've already identified properties, they could contact us to revoke the identification.
Right.
If they revoke the identification, then, it's a failed exchange. And after day 46, we can give them back their money.
After day 46, we can give their money after the 45th. Perfect. Next slide, please. Okay, so at the identification period, they have the choice of either picking 3 properties. Sometimes you get some very gregarious folks that want to buy 4 or 5 properties for the one. Okay, but the 4 property rule, anything over the 3 would have to abide by the 200% rule, which means that if they want to buy 4 properties, they are going to double the sales price. So that 1.5 million would now be 3 million. The aggregate total of the replacement properties, the 4 that they want to buy, cannot exceed 200% of the original value. Okay. But that's stuff that the exchanger, we go over the exchanger. You folks with us, we're keeping it simple. We're keeping it to the parts where you are going to shine during the exchange. Next slide. Let's talk about boot, Adrineh.
Okay, so boot, when I was in escrow, and that question comes up now that I'm doing the exchanges, people used to call me and say, I know we have a 1031 exchange with you, but I would like to cash out $50,000 and go to Vegas. I don't know, have a good time, take a vacation. So any money that you touch, you have as an investor to pay boot on. Boot means basically tax. If you do it through the course of the escrow, it's 3 1/3 for the franchise tax board. And then also you would have to pay capital gains on it when you do the taxes at the end of the year. There is also such a thing called mortgage boot. So when Marcus was going over the numbers and he said, you know, you have a $1.5 million property you're selling, besides the non-recurring closing costs, there's also, if there's a mortgage that's being paid off through the escrow, that mortgage has to be replaced when the investor buys a replacement property for the same amount. Or if they don't want to finance it, they have to bring in cash from somewhere for the same amount of the mortgage that was paid off. Otherwise, if they buy less or they don't replace the mortgage, they have to pay again boot on it, which is 3 1/3 through escrow and capital gains at the end of the year. When
Let me ask you all a question. Just because a property that sells for 1.5 million has a loan on it, does that make it any less value? No, right? So when that money comes in from the purchase of it, title needs that money so to pay off the loan, right? That's what the IRS sees as and recognizes as constructive receipt if it's not replaced in the transaction on the replacement, if it's not replaced. So you carry any debt forward because debt doesn't mean that the value is diminished of the property. And in order to defer your taxes, it has to be value for value or higher. All right, next slide.
Marcus, why do they call it boot?
Boot. Oh, historically, because remember how I told you how this was created with farmers? When the farmers would have any leftover money, they would hide it in their boot. So with the 1031 exchange, folks, look, we go from only being able to use 60% of our proceeds to now being able to use 100% of the proceeds. And next slide. There's different types of exchanges. We pride ourselves in being one of the companies that has a total department devoted to these two, the reverse and the build to suit. In markets, in tight markets like we have, we're seeing a lot, right? We're seeing a lot of reverse exchanges where they purchase the replacement property first. That's a little bit more expensive because it's a work of art. You have to replace that property. You buy the replacement property first, and then you sell the relinquished property. And to do that, it's a little bit more complex because we have to take title to one of the properties. The IRS does not allow you to own two properties at the same time. The other one too is build to suit. Build to suit where you buy a land and you develop on it at value within 180 days. Another work of art, okay? We do that, and we have a great team that does it. We have a lawyer who heads up the administration team for those two. The other one would be, the typical one is the delayed simultaneous. In California, not so much because it would be akin to a concurrent closing, which we don't see, right, title folks? We don't see that much. Yes.
Real quick, so we are getting some calls about build to suits for investors that are looking to buy properties that need capital improvement. So that is something else that they can do a 1031 on if there is actual major capital improvements that can be done on a property they're purchasing. That can also qualify for a 1031 exchange. If you have anyone like that, reach out to us. We'll put you through to our
Great team.
Yes.
We're only good as our team that backs us up.
That's right.
Right? Our in-house team do a fantastic job. Last slide, I believe. So we have a masterclass syllabus. I know that she does as well. I put Marcus, I didn't even change that agreement.
Okay.
We work as a tight team. We can talk at your offices about building investor relationships. We can actually do that here at a class. We do tax deferred strategies, more advanced strategies. And then what we always like to do is give back to our realtors and show them the critical role that they play in this. I'll leave you with this story. I was just in Puerto Vallarta over the holidays, and the Sunday before I came back, I was sitting at this restaurant with this American couple. What do you do, Marcus? Well, I work in 1031 exchanges. They both almost dropped their forks and they looked at me and they had gone pale. Where were you 5 months ago? They sold their property and their investment property, and they realized they took a big capital gains hit. In fact, they looked like they had almost suffered a heart attack. And they said, and your realtor didn't know about this? They both said, his name is Mud, because he didn't know this. All right. So hopefully this is very valuable information to you. And thank you for allowing us to come here and look us up. If you'd like some more information about that, here we are to service you. And I can't think of a better group to service than my family here at the, our family here at the WSGVAR. Thank you so much.
Thank you, everyone. Thank you.
Yeah,
Right? It was set at 12 million. Oh, it was set as, it was set at 12 million. We don't know what's going to happen this year. So, but as long as when they bequeath that, their estate does not exceed 12 million,
well, it's
there
500
won't be
million.
that, there won't be that inheritance
So,
tax.
so they still have to pay estate tax. They just forget they only get.
Well,
about
no, if it's bequeathed to them in a trust, they're going to get it at current market value, right? They're going to get it current. So they're going to be able to defer all the capital gains tax. That's going to take care of that. But should it be more than that, okay, they would still be able to defer the capital gains tax, but they would be charged an inheritance tax of about 35% on anything that exceeds the 12 million. Okay?
Okay.
Yes, yes, sir. Yes.
Yeah, good morning, both. Very informative information, but one thing you didn't mention is the foreigners.
Ah.
The owner as a foreigners and how they do exchange.
Right. We do that in our more advanced class. Okay. Foreigners who own property here in the United States, they can do a 1031 exchange, but what they have to do is they have to get an ITN number or an ETN.
Yes, and what they want to do is they could try to, get some kind of a waiver, but it's never gonna come in on time. So it's best for them to bring in the 15% IRS withholding amount into escrow and the 3 1/3 for the FTE.
That's pay upfront, right? Before
Yeah,
they can
they bring
claim
it into
back.
escrow and they deposit it there, yes, for that to be paid, yes. And then they can try to get that back, some of it, all of it, I don't know, depending on their financials and the year-end taxes. That
So they should apply for tax ID first
yes,
and
for
then
sure.
come up with the money and then do the exchange. right?
Because when escrow goes to submit those funds, they want to have some kind of a tax ID number on the forms.
Okay, thank you.
All right. So I know you probably answered this, but what if the owner lives, it's like a triplex?
Uh-huh.
So they live in the front house and they have a duplex in the back.
Sure.
That's investment.
Sure. Well,
Will that,
that's my situation.
okay.
That's my situation. I live in part of my duplex. So all of this is guided by your CPA. We are just the processors, right? We don't give advice. We structure the exchange to suit the CPA and the exchanger. Okay. So what happens in that situation, my CPA and their CPA will bifurcate what is value that we can claim our universal exclusion on. And the rest is going to have to be exchanged. Okay, so they will bifurcate the
parts.
value. Exactly. They will bifurcate the value that is for home use, for personal primary residence, and then the value that is for rental. And you can claim the exclusion on the primary residence, and you can exchange on the other part. Yes. Yes. So the key is your CPA, your CPA, your CPA. Yes. Yeah. Right. Right. We never and bless my friend Phil, he was always confused with the CPA because he did know a lot, but we're not the people that make those decisions. We talk. Typically what happens, you meet with the client, they want to do a 1031 exchange, they have some issues there. We say, go to your CPA, speak with your CPA, and then come back and we'll do a conference call with all of us, right? Next question was in the back. Yes. Okay. So the property's under an LLC. I believe that they would have to get an ITN.
Yes, they must probably have an entity tax ID number. If they create the limited liability company, it was a requirement. So they could do the 1031, they just have to bring in the funds into escrow. As far as I know, they can still do the exchange, yes. If you like to get a
Thank you, Marcus and Adrineh. On behalf of the Western Gabriel Valley Realtors, I would like to thank our guest speakers for a very informative and knowledgeable presentation. And I have some small tokens of appreciations for you. Thank you. Please join us next week as we welcome CPA Jeff Huang, who will be giving us 2025 tax update. Thank you everyone for joining our meeting today. Have a wonderful day. This meeting is now adjourned.